Yeah, good morning and welcome. Buying a home is getting so complicated that it can't be accomplished by one person. In order to make sure the procedures happens properly and smoothly, a real estate broker has to rely on experts in related fields, and that's why I've called in Ben today. He's from Academy Mortgage, and we're here to discuss the first process of buying a home, and that's getting the money to get it accomplished. So, welcome, Ben.
Yeah, thanks for having me, Marty.
Now, you've been with Academy Mortgage, you just made a change, didn't you?
Yeah, just transferred from Guild Mortgage Company. Guild was a great company to work for, a lot of great people over there, and just saw a better opportunity to help home buyers and also assist real estate brokers in their listings over at Academy Mortgage.
So what the person is supposed to expect when they first meet with you?
Well, the really first step is to get an application filled out. That can be done one of a few different ways. Most people choose to do it over the internet, and we're really going to take the person's information that is required for the loan application, also called the 1003. So that can be done online. Applications really don't take any longer than 15 minutes, and again, they can be done online or over the phone. Cool.
Now, one of the things that I always want to get accomplished, the very first thing is that you get a pre-approval so we can find out how much they can afford. I don't want anybody to end up house broke.
Right.
So how is that accomplished?
Right, so the application, I think we'll touch on it later, the application allows a lender to look at the borrower's information, look at the stated income, and look at their employment, make sure everything looks good, and then run what's called desktop underwriter to see if they are the term pre-qualified. And that will allow us to see, okay, do we have a borrower that has a good chance at purchasing a home? If everything looks good from their credit to their income to their employment, then we'll ask for the required documents to verify that information. Those documents, for the most part, include tax returns, W-2s, pay stubs, and a borrower's bank statements. So really the information they put on their 1003 or their application, now we're just verifying that information to be correct or how a lender looks at it. So most of the time it is what they put, but dealing with people that are self-employed or own businesses, income can be viewed a lot of different ways, and we just got to make sure it's viewed the correct way.
Mm-hmm. One of the things I noticed, I had a carpet cleaning company for a number of years, and my tax guy was pretty good. And so when I tried to get a loan, there were some challenges. So you guys look into that and make sure that the different aspects of different kind of businesses are able to come up with a true figure.
Right, absolutely. And it's hard because self-employment, anyone who owns their own business or works on commission income, you're doing all the right things to have those write-offs come tax time. But when it comes to getting pre-qualified or pre-approved for a home purchase, we have to look at those write-offs and see how much money is actually coming in. And for the most part, depending on the loan program, they're going to use a 2-year average of self-employment income.
Mm-hmm. Cool. Now, the difference between pre-qualified and pre-approval, can you give us a better explanation?
Right, yeah. So going back, when a borrower fills out their online application or takes an application over the phone, the lender's going to be able to give the term pre-qualified. So I'll take an application over the phone, or a borrower will fill one out online, and I'll call a borrower and let them know you are pre-qualified based on the information you provided. You're pre-qualified for this amount. Now this is the documents again: the W-2s, pay stubs, tax returns, and bank statements. I'll need to verify the information they put on that application is correct, and then that term pre-qualified is now their pre-approved amount. And the big thing with the pre-approval amount, and this is what I always talk to borrowers the first time, the pre-approval amount isn't necessarily where you want to be looking. What's more important is, where are you comfortable in your monthly mortgage? Because I may pre-approve a borrower for $2,000 a month in their home purchase. Well, they're not comfortable spending over $1,500. So a lender's going to give you that top dollar that you're pre-approved for, but really what's more important is what a borrower is most comfortable spending in their monthly mortgage.
Mm-hmm. So we don't want him to end up house broke.
House poor, yes. You don't need to shoot for the stars every time that your pre-approved amount comes out. That doesn't necessarily mean that's where you want to be house shopping for.
Mm-hmm. How about what's the difference between an inspection and an appraisal?
Good question. So It really goes back to, if you have questions for your lenders, when you're looking at lenders, you should always make sure they're available. And please always ask any and all questions you have. This is a thing you do maybe one time, couple times in your life, and you want to make sure you have all your questions answered and you're confident moving forward. So the difference between an inspection, a home inspection, and an appraisal, two very different things. The home inspection is done for you. It's done for the borrower. It's not required by any lender. But as you know, the home inspection, you're making this big purchase. You're making $100,000+ investment. You want to make sure that you want to purchase this home. So the home inspector you are hiring, you pay for that home inspection. Again, it does not have to do anything with the lending part of the process. So you purchase this home inspection to have a home inspector go out and inspect this home, very detailed. So they're going to go over every nook and cranny of this home and give you about a 20 to 30 page document of the home, just stating every single thing that they pointed out that could be fixed or is a concern in their opinion.
Mm-hmm. Now this is a important part of the process because you don't want any surprises when you buy it.
Correct.
And it also, in some cases, it'll help in the process when we're talking to the seller to determine where the house is going to be priced.
Right, and yeah, at this point, you wouldn't do a home inspection until you have an accepted offer. Once you have a accepted offer, your broker will help you set up the home inspection. And then you get this home inspection report. Now, this is your tool to go back to your real estate broker and talk about, okay, these are the things that are concerns. This is kind of an estimate of how much it would cost to do these repairs that I would like done. Now we can go back to the negotiation table and say, okay, I want these repairs done by the seller, or they're going to have to reduce their sales price or give me a credit for X amount of dollars. Mm-hmm. So it's really, you need that tool to go back to the negotiation table. Because if you just say, oh, I saw this, well, it doesn't bring a whole lot of weight unless you have a home inspector do that report for you. Mm-hmm.
Now, one of the challenges I run into is, and I think it's getting a little better, but the appraisals have been really a challenge to get done on time. What's happening there?
Yeah, well, the good news is 2016, we're no longer there. So 2016 appraisals, depending on the lender, depending on who you use, let's say an average of 3 weeks out. Now, sometimes when you get out of the Marion counties, the bigger cities, and you go to the USD areas, yeah, you were looking 5 weeks sometimes to get appraisal mm-hmm. back, and especially on the VA appraisals as well. We just had an appraisal shortage in Oregon. Oregon is one of the 3 states that's really feeling that appraisal shortage. Oregon, Washington, Colorado, a lot of people are moving to this area, and we just don't have the appraisers to appraise those homes. The good news is 2017, most lenders are down to a 10 to 14 day turn time. So it's really not an issue anymore. Again, a good question to ask your lender: how is your appraisal turn times? Because not all lenders are created equal in this part of the process. Some banks, some credit unions don't have as many appraisers accepting their appraisals as other lenders. Some lenders can choose to pay these appraisers more. Some banks, some credit unions will charge or take more of the fee that's charged to the borrower away from that appraiser. So if you're an appraiser and you can appraise the home for $400 or appraise the home for $600, which one are you going to do? These appraisers are out making a living as well, and if one lender isn't taking any of that money that they charge the borrower, they're giving it all to the appraiser. Well, those appraisers are going to want to pick up those appraisals from that lender more than the lender that's taking half of that fee to the borrower.
I went to a seminar with Academy Mortgage, and you guys have a pretty good record that way, as I understand it.
Yeah. We're known as the 10-day appraisal company. We have since gone away from that. We have so many appraisers working for us that we even open it up more. And we happen to be a lender that gives all that money that we charge the borrower to the appraisers. So they are getting those appraisals done. They see appraisal requests coming from Academy Mortgage. those are probably going to get picked up faster than any other lender. So we're very proud that it's not something we're trying to make money on. We just want to expedite the loan process for the borrowers, for the sellers, and get the loan done as soon as possible. And touching on your question about the difference between home inspection and appraisal, the appraisal is done for the lender. The lender's going to borrow this amount of money to the borrowers, and they want to make sure what they're borrowing, their asset, the home, is worth that they're borrowing it for. So the appraisal is to make sure the home is valued at what the seller is selling it for.
Wow, yeah. One of the things in the approval process is a credit score. Can you guys help some folks? I've had some folks who are just on the edge. And I remember one time you did help me with a client who was, I think he was at like a 550, something like that, and you brought him up over 600, and we were able to get it done. Tell us about that a little bit.
Yeah, so credit, I mean, that's a big topic. Lots of things go into credit. It's probably the number one thing that stops lenders from being able to approve borrowers. For the most part, again, every lender has different criteria as what they'll accept as far as the lowest credit score, and it, again, depends on the program. But a good general rule of thumb is 620. 620 for most of the programs. Yes, we do go down to 580 on some programs, but again, if you go lower than 620, then additional criteria comes in. So 620 is a good rule of thumb for the 4 major loan programs. How to get there, what goes into it. The big things that affect a borrower's credit score are on-time payments, a history of on-time payments, and utilization of credit. So how much credit has been extended to you and how much of that are you using? So those two things make up 65% of a borrower's credit score. Other things include basically the diversity of credit. Do they have revolving? Do they have installment? Do they have mortgage loans? How long a history do they have? Are they brand new borrowers? So those tiny things make up the rest of the 35%. So, but the two things a borrower can control are the utilization, how much, in most cases, credit card debt are they using, and on-time payments. So just making the minimal on-time payment is great. That'll improve your history, and the things that really, from my opinion, and lenders will agree with this, that really hurt a borrower's credit score are the late payments. Those drop a person's credit score a long time, and then that is not immediate. The utilization of credit is immediate. So if you're able to pay off that credit card debt and get it down to 30%, which is good, or 10% of the credit that's been extended to you, which is ideal, that's immediate. Your credit score will jump up those X amount of points, and a lender can tell you exactly that. But the hard part is if a borrower has had late payments or negative things gone to collections, that does take time to slowly come off or not affect your credit score as much.
Does it eventually fall off?
Yeah, so every what's called derogatory has different time lengths that it's going to stay on a borrower's credit report. For collections, I want to say it's 7 years. Bankruptcy, depending on the time, 10 years. So they eventually fall off. But the good news is, as time goes on, they affect the score less and less because it's more into the history.
Mm-hmm. Now, what's the difference between conventional loans, FHA loans? I've had some challenges at times with the VA loans. Like you were saying, I think it's a lack of enough appraisers to get the job done.
Yes. So, yeah, and really what I want to get out to everyone is that the VA appraisal turn time is much better now. So there was a time last year, and it's unfortunate. These are vets that have served our country, and they were almost getting blackballed and getting accepted offers because the turn times were 2 months sometimes. So really what lenders are trying to get out right now is that VA turn times are much better. We can close loans still in under 40 days. It's not a big issue anymore. So when you're going and speaking with the lender, some borrowers are looking at FHA or conventional loans. Well, how do I know which one to choose? And that's when a good lender will sit down with you and go over your side-by-side comparison. A good rule of thumb, I think, is where you're going to see where, well, we're kind of similar as far as your monthly payment between FHA and conventional. It really comes down most of the time to credit. If you're above a 680 to 720, you're kind of going to be in that medium ground. Should I go conventional? Should I go FHA? The payment's going to be very similar if you look at the two based on those credit scores. When it's really cut or dry, if you're below 680 or if you're above 720, conventional is going to work out better. If you're below 680, FHA is going to be a much better loan program for a borrower just based on monthly payments. What a good lender will do is really ask the next question. Well, what is your long-term plans for this home? Is it going to be your 8+ year home, or are you going to be, living in this for 5 years and moving on? If you're just going to be living in this home for 5 years, then you really just want to look at the payment. I want the lowest payment. Mm-hmm. If you're going to be in your long-term home, the negative part about an FHA loan is that mortgage insurance.
Yeah.
The mortgage insurance on FHA loan is for life. So you'll be paying this mortgage insurance. We can talk about mortgage insurance a little bit. You'll be paying this mortgage insurance for the life of the loan. So it's just money that goes out the window, which would go away on a conventional loan, and you pay it for however long you're in the home or however long you have the mortgage. So that's when the lender will sit down and ask you what's your long-term plans for this home, and then help you decide, okay, this is your monthly payment for your conventional, this is your monthly payment for your FHA. Mm-hmm. Let's do a little positive negative here and talk about your long-term plans, and is it worth it to pay a little bit more for a conventional perhaps if in 7 years that mortgage insurance is going to drop off and now your conventional payment is significantly less than the FHA payment. Mm-hmm. So different kind of things, and all good questions, and it's really by borrower based as to what they should do. I can't say a 690 credit score should do this loan, a 6 or a 730 should do this loan. It's really based on the borrower.
Mm-hmm. I remember the first time I heard about mortgage insurance, I thought, that means if I die, it pays off the mortgage. Ain't so.
Not so. Good question. So mortgage insurance. Mortgage insurance is insurance for the lender in case a borrower defaults. Mortgage insurance comes when a borrower puts less than 20% down on the home, so less than 20% down payment. You're going to have mortgage insurance. Mortgage insurance on a conventional loan will drop off once a borrower reaches that 20% equity in the home. Mm-hmm. So it's a nice thing on the conventional side that, yes, this is a payment I'm making monthly because I put less than 20% down. However, it will go away once I have that 20% equity. So again, mortgage insurance, the way I describe it to borrowers, it's like car insurance if you don't get in an accident. It's just money going out the window. It doesn't do any good. It's not going towards paying down your interest or paying down your principal. It just goes out the window. It's insuring the lender in case you default on the loan.
Wow. Anything else you want to let us know about this? Yeah,
so mortgage insurance there's lots of different things you can do with mortgage insurance. You can have a lender pay it and you can increase the rate. You can do what's called a split premium where you pay a chunk up front to lower your payment. So there's a lot of options to go into. Again, it's really based on what the borrower wants are. Do they want a lower payment? How long are you going to stay in the home? So all these questions are really good questions to ask your mortgage advisor on, what should I do? And then they should ask those kind of questions. Well, what are your wants? Do you want a lower monthly payment? How long are you going to stay in the home? So all those questions will help a lender decide what the best way to set up their MI, whether it's going to be borrower paid monthly, is it going to be lender paid, is it going to be some sort of split premium where they put a little bit down to have a lower monthly payment? And it's really based on borrowers. It's not a cut and dry thing. If you have a lender that's just taking your application, putting you into a loan program without discussing those kind of things with you, you're probably not working with the right lender.
Mm-hmm. I run into a lot of challenges with, not everybody, especially young couples, don't have that 20% down. And I know that there are some lower down payments available. Can you give us an idea about what that's all about?
Yeah, so Down payment is a big, or can be a big hurdle for a lot of families. If they're not selling a home, a lot of people get their down payment from selling their current home and have the equity saved up in that home, or a gift from a parent or a relative for that down payment. So there are some good low down payment options out there. Of course, USDA. So any home in this area, in a rural area outside Salem, Kaiser, Woodward, Albany, qualify for zero down through the USDA. Great program, very low mortgage insurance. FHA comes with the 3.5% down payment requirement, still considered a low down payment. And conventional, there's 3% down payment option. So all really good low down payment options. The VA, of course, can't beat that loan program. It's a zero down, no mortgage insurance. So all three loan programs have very low down payment options. When you hear about these down payment assistance programs, different programs that allow for gifts and different things, those are worth researching. But again, you want to speak to a well-known lender or someone that knows what they're talking about to make sure you're getting the right deal and making sure it's a good program for you.
Mm-hmm. Wow. I don't want to tell my age, but when us baby boomers landed in our early 30s and started looking for homes, they had a Farm Home Administration loan out there. It's called a 235.
Yeah.
And I think it cost me $300 down, and the government made the interest payment, and I just made the payment.
Yeah.
It was great.
Yeah.
I don't think we'll see those very often anymore.
No, and the hard thing is, we're doing this interview in October 2017. These kind of loan programs for down payment assistance, they come and go. They come and go with different lenders. So they're worth checking out. If someone's going to give you free money, why won't you take it? Again, though, if you're getting something for free, you want to understand what that's doing. A lot of times, if you're getting a certain amount of gift for a down payment or any kind of these programs, you want to see how that correlates with your rate. A lot of these programs increase a borrower's rate, so in the long term, they're not getting a better deal. Mm-hmm. But it is making up for that hurdle of getting them into the home. So again, always talk with someone you trust to understand what you're fully getting into. A good lender will always be able to give you a cost estimate prior to you putting in an offer on your home. So mm-hmm. I know I have borrowers out there, and they may be shopping with you, and you go and look at a handful of homes in a day, and they'll come back to me and say, Ben, can I get a full cost estimate on these 3 homes at maybe 3 and 5% down? A good lender should be able to provide those to them very quickly, and so they can have a good forecast into, okay, if I go with this home, my monthly mortgage is going to be this. My total cash out of pocket is going to be this. So again, you want to have those borrowers feeling very comfortable and confident when they're submitting that offer.
Mm-hmm. Let's talk about closing costs for a minute. That's kind of I guess it almost seems sneaky, but it's not. I mean, there's a lot of aspects to that closing cost, but people ought to know about it. Could you give us an idea of what that's all about?
Yeah, I think sneaky is a unique word. I think it could be termed that just because a lot of people are unaware.
Right.
They hear I have a 3% down payment. They think, well, that's what it costs to get in the home. Technically, it can be. You can that is the minimum requirement to purchase that home. If the 3% down is what's required, then yes, you can get into a home for 3%. So how I like to explain it is closing costs are made up of 2 parts. One part is for the people that are working on doing the loan. You have the appraiser, you have the lender, and you have title. Title and escrow, you'll hear those names or words used congruent with each other. So you have those 3 groups working on to do your loan process. So that's one part of your closing costs. And then you have what's called your impounds or your prepaids or setting up your escrow account. Again, all use the same. So it's 1 year of property taxes paid up front, 1 year of home insurance paid up front. That's the majority of those, and there's also what's called a per day interest depending on what day of the month you close. But that's the second part of the closing cost. Those are required by whatever lender you use. Those are always going to be required. In this area, it's hard to say exactly what the closing costs are going to be. Every lender is a little bit different, but generally the same. If I had to throw out a general rule of thumb, you could probably calculate your closing cost to be 3,500 to 4,000, yeah, $3,500 to $4,000 plus 1 year of property taxes. That's kind of just an overall rule of thumb that your closing costs are going to be for any given home in this area. And that includes the appraisal, that includes escrow, that includes lender fees, and then add 1 year of property taxes to that. It's a good rule of thumb. That $3,500 to $4,000 includes a year of property taxes as well. Now, well, the good question is, what do borrowers do? I only have the minimum down payment. And this is how the negotiation comes that you do with the putting in the offer. How do I get a home if all I have is this minimum 3 or 5% down that I have for the home? And the great thing is the seller can pay a borrower's closing costs. And I know you've written plenty of offers that have the seller paying those closing costs. And we all know that the seller is able to do that. Now, well, why not always have the seller pay the closing costs if they can? Well, they may not want to. And, the seller is going to have a general idea of what amount they would like to net on the sale of their home. So sometimes if they're going to increase the price of the home X amount of dollars, if they're going to give that same credit to the borrower for their closing costs. Which, again, it gets us over that hurdle. How do we get this family or this borrower into the home? And it allows us to do that.
Mm-hmm. I was aware that the market has changed considerably over the last couple of years from what would be called a buyer's market into the seller's market. And I've noticed that most of the sellers now are not given a whole lot of inches on what they're going to do for closing costs. But that's one of those negotiations you can take care of when you get into it. I see we're getting close to getting down to the bottom of this. I guess you have anything else that would be helpful to...
Yeah, and you brought up this is, we're kind of in a seller's market. It is leaning that way in Oregon just because of the demand of housing. We have what's, I guess you consider a housing shortage. Just there's not as many homes on the market as there are borrowers looking for homes. But in a sense, you can still also say it's a buyer's market, that being that the interest rates are still at all-time lows as far as history is concerned. So people are still able to borrow money at a really good rate and get into these homes at a far less expense than, at least my parents did, or, So they're able to borrow and get into this home where people are saying interest rates are going in 2018, 2019. Well, they may be able to afford a far less expensive home if they wait into 2018, 2019. So when people ask, yes, it is a seller's market, but in those terms, it's also considered a buyer's market as well.
Mm-hmm. I've been noticing lately that the prices tend to be dropping this time of the year. So, yeah. Well, looks like we're about out of time anyway. Appreciate you tuning in, and we'll be back with you again next week.